Joining me now, we've got Ruben Hovhannisyan, who is the TCW Fixed Income Generalist Portfolio Manager. Great to have you here with us today, Ruben. So first and foremost, just got to get your reaction to that much hotter than expected jobs print and what that signals for portfolio strategy as well right now.
Good morning. Thank you for having me on. Well, it was generally speaking, a fairly strong report on multiple fronts. Although, if you wanted to pick a weak data point, you could look at average weekly hours, which declined. Aggregate hours also ticked down slightly. Or you could look at temporary help employment, which is often viewed as a leading indicator, and that continued to decline. But generally speaking, again, strong report. That being said, it's just one data point, and it's important data point, should not be ignored, should be incorporated into analysis. That being said, we should recognize that this is a series that has been very volatile, subject to seasonal adjustments and many other adjustments in the past. Let's not forget that a month ago, we learned that a non-farm payroll creation over 1 year period was revised down by about 30%. So while should not be ignored, it should also be taken with a grain of salt or a fistful of salt. And more importantly, it should also be put in the context of overall labor market indicators. And I think when you look at the bigger picture, global market labor market indicators, broader labor market indicators, you see, they paint a picture of certainly a weak and weakening labor market. Will you look at hiring rate? Jolts report came out earlier this month, and it's, hiring rate is at 3.3%. You really have to go back to 2013 to see those levels. Quits rate is low and declining. You look at ISM manufacturing employment rate, again, levels that go back to probably 2008 to see those levels. And also, if you look at the surveys of what consumers or what the population is saying about labor market, the labor market differential indicator, which takes the difference between those who say labor jobs are plentiful and those who are saying jobs are hard to find, this is continuing to go down, which means that people are having a hard time finding jobs.
Ruben, as we've been discussing it throughout the morning, many of our guests pointing out that this might change what the neutral rate for the FOMC starts to look like, which thus does initiate at least a little bit of a duration-focused investment portfolio shift here. As you're looking at it and evaluating it on the fixed income side, what type of duration shift might that initiate?
Well, we don't think that 1 month unemployment report should change where the neutral rate is. The neutral rate is impacted by many factors. Most of them are, most of them are secular in nature. They're based on long-term trends. So 1 month report may not. That being said, we do see repricing in the rates market. So the investors seem to, believe that this economy is growing stronger, and that may require less rate reduction. If you look at the rates market today, speaking of rates and duration, as of yesterday, the market was pricing closer to 3 cuts this year, 70 basis point of cuts this year. Now they're pricing closer to 55, 60 basis point, which is closer to 2 cuts.
Right.
The number of cuts next year has come down as well. So the front end of the yield curve is higher, generally speaking, which seems to suggest the market is taking it as a indication of stronger economy and the yields that will be higher than the market thought yesterday.
Right, and I certainly do agree. We don't want to just zero in on 1 month, but when you have a report like this plus revisions for previous months, that's where it starts to change that trend a little bit more. And so if you're looking out into the future, and for a lot of investors that have tried to make sure that their portfolio strategy is not fighting the Fed, but anticipating perhaps what their policy pathway may look like in the amount of cuts or the depth of cuts that are anticipated even into the end of the year and even into next year, where, as you look out into 2025, does that kind of set up your own strategy and how investors should be positioning themselves?
Sure. So we think that we've thought and continue to think that the economy is continuing to decelerate, and that deceleration will become more pronounced towards the end of the year and early 2026. With that in mind, we think that the Fed at some point will have to actually accelerate cuts, which is not something that the market is telling you today. But we think the Fed will probably have to accelerate cuts, because let's not forget that even after 50 basis point cuts, we're still in a fairly restrictive territory. So even if you think that the economy is not slowing, even if you think it's at full employment and it's not overheating, it's not slowing, the Fed rate should be closer to neutral territory, and that neutral territory, regardless how you measure it, is at least 200 basis points lower from here. So we think that the Fed will have to accelerate cuts. We think that what's being priced in, which is 25 basis point incremental cuts over the next year and a half, is not going to be sufficient to stimulate the economy sufficiently to forestall the slowing economic growth. We think there is a little bit of inconsistency between where the economy is and where the rates are, which is still at a fairly restrictive territory, about 200 basis points at least higher compared to where the neutral should be. So we are overweight. We do think that it warrants to be overweight at this point, especially in the front of the curve. The 2 years and 5 years, which will benefit more from faster rate cuts than what's being priced in.
Ruben, thanks so much for taking the time here with us today. Ruben Hovhannisyan, who is the TCW Fixed Income Generalist Portfolio Manager. Have a great weekend.
Thanks, Brad. Always a pleasure.